One is new, fully stocked, and sailing smoothly. The other is old, barely floating, and missing equipment. Now what if both were priced the same? Would you buy the old one just because it's a ship? Probably not, but in the stock market, investors sometimes do something similar. That's where the price-to-book ratio comes in. It helps check if a stock is priced fairly compared to what the company actually owns. Let's break it down in a moment. Hey there, this is Yahoo Finance, where investing concepts are explained in a simple way. But first of all, a quick disclaimer. Alright, so what is the price-to-book ratio? The price-to-book ratio compares a company's market value to its net worth. It's calculated with this formula. Price-to-book ratio equals market price per share divided by book value per share. Book value per share is the company's assets minus its debts. Let's take an example. Company A has $100 million in assets and $40 million in debt. That means its book value is $60 million. If the company has 10 million shares, the book value per share is $6. If the stock is trading at $12 per share, the P/B ratio is 12 divided by 6. What does the P/B ratio tell us? If the P/B ratio is below 1, the stock is trading for less than its book value. It might be undervalued or a warning sign. If the P/B ratio is 1, the stock price matches its book value. This means it could be fairly valued. If the P/B ratio is above 1, investors are paying more than the company's book value. This is usually because they expect future growth. Let's look at 3 examples. Tech giant Corp has a P/B ratio of 10.5. It's an AI company with most of its value in software, brand, and innovation. Investors expect massive growth, so they pay a premium. Classic Furniture Co. has a P/B ratio of 0.7. It owns warehouses full of inventory, but investors think its assets are outdated. That's why the stock trades below its book value. Steadybank Ltd has a P/B ratio of 1.2. Banks usually have P/B ratios close to 1 because they usually own tangible assets like cash and loans. When is P/B ratio useful? The P/B ratio works well for asset-heavy industries. That includes banks, real estate, and manufacturing. It's not as useful for tech companies or brands. Software companies rely on intellectual property, not physical assets. But there is one important warning. During the 2008 financial crisis, bank stocks crashed and their P/B ratios dropped below 1. On paper, this made them look like great deals. Some investors thought they were getting a bargain. But there was a hidden problem. Many banks owned risky investments that weren't worth as much as they claimed. Their financial statements made them look stronger than they really were. When the truth came out, some banks collapsed, like Lehman Brothers, while others, like Bank of America and Citigroup, needed government help to survive. That teaches us that a low P/B ratio doesn't always mean a stock is cheap. It can be a warning sign. Before investing, it's important to understand why the stock is priced so low. The P/B ratio is like checking if a house is worth the price before buying it. But just like houses, companies are more than just their materials. Future potential matters too. Finally, I will show how you can get this number easily from Yahoo Finance. You will type the name of the stock in Yahoo Finance. Then, go to Statistics and you will find this ratio. This is a clear example where the P/B ratio isn't very useful. Coca-Cola's P/B ratio above 10 reflects its strong brand and consistent profitability, which aren't fully captured by book value. Each stock is a world of its own.